Go to 1B. Question 1B, are you there? Are you there with it, please?
Yes, sir.
Divide the term these economies of scale. When we talk about these economies of scale is a cost disadvantage that occurs as a result of expansion. So what I'm simply saying is that when a firm is expanding, it is expected of the firm to reduce its average cost of production. But if the firm is expanding and its average cost of production is increasing, that is diseconomies of scale. Is it clear?
Yes.
Good. Question C. Divide the term job production. When we talk about job production, we're talking about a method of production that involves you producing a unit of output at a time. So we want to produce pen, we produce just this pen at this point in time. That's what job production is. We need a pen, we produce the pen. Then before we talk about something else, that is job production. Is it clear? Yes. We move on to question D. State one financial methods of motivation Artify Studio could use to motivate its employees. I wrote bonus. Artify Studio might use bonus given additional pay to its employees if they are able to sell more artworks to the customers. Or if customers are able to buy more artworks. I think it's clear.
Yes, sir.
Question E. Artify Studio offers a 12% discount to parents if they book the dual parents and child art camp and the children's illustration workshop at the same time. The combined price for both courses before being discounted is Singapore $285. Calculate the discounted cost of booking both courses at the same time. You are advised to show your working. So the working is here. The discounted price, the discounted cost is, the total cost is $285 minus the discount given. Discount given is 12% on the price. So 12% on the price is 34.2. So 285, which is the cost, minus 34.2 gives us 350.80. So that's the answer. We move on. That's question E. We go to question F. It says, explain one measure a business can use to judge its success. The success of a business can be measured through the market share. Why do I use market share here? Market share means the total brand sale divided by the total brand sale divided by the total market sale multiplied by 100. So if Artify is doing well, if a business is doing well, if its market share is increasing, it means it has had more customers from its competitors. If you are increasing, if your market share has increased from the previous year, it means you are having new customers. And having new customers means the customers of your competitors are started buying from you. Because there's no customer in heaven. All the customers are here. So if you are adding more customers, it means some of your competitors are losing their customers. So if some of your competitors are losing their customers for you, it means your business is successful. Do you get the point here?
Yes, sir.
Any question about that?
No, tell me.
Okay, so go to question G. Analyze the effect of a decrease in interest rate on Artify Studio. An increase in a lower interest rate could increase the demand for its art. So when we talk about lower interest rate, it means the cost of borrowing becomes cheap. So if the cost of borrowing becomes cheaper, it means Artify Studio might be able to borrow more money to expand its business, maybe for advertisements, to create more awareness. If the cost of borrowing is cheaper, it allows businesses to be able to borrow more. So in case of Artify might be able to borrow more to expand its business or to make advertisements. And if Artify is able to spend on advertisement, it will create awareness about its products. Do you get the point? And another advantage of interest rate is that it reduces, as it reduces the cost of borrowing, consumers might be able to borrow more money from the bank. So if they are able to borrow more money from the bank, they might be willing to buy art materials or art sets because they have money now, because they are able to borrow. And that increases revenue for Artify Studio. Is it clear? Is it clear, please?
Yes.
So I think that ends question 1. Have it, please.